In this lesson, we will learn about strategic acquisition financing. This lecture will cover the following. 1. Determining external financing requirements. 2. Assessing internal funding capacity. 3. External financing. The debt capacity question. 4. The debt versus equity decision matrix. 5. Simulation exercise. After assessing internal funding capabilities and exploring debt capacity, companies must decide on structuring the right mix of debt, mezzanine, and equity financing. This decision is pivotal as each type of funding offers distinct advantages and trade-offs, including tax implications, cost of capital, and control over the business. 1. Cost of capital considerations. Debt's advantage. Interest payments on debt are typically tax-deductible, making debt less expensive than equity financing. Lenders also generally bear less risk than shareholders, further contributing to the lower cost of debt. Impact of future earnings. If the acquisition promises to boost profits significantly, a higher proportion of debt financing can be advantageous. Greater earnings enhance the company's ability to manage interest payments. 2. Strategic funding choices. Mezzanine financing. Mezzanine financing can be a strategic choice when pure debt increases risk excessively, yet traditional equity financing would dilute existing shareholders too much. This often includes options or warrants, which can be less dilutive than straight equity. Equity considerations. In scenarios where the burden of debt could be too constraining or where strategic investors might bring more than just capital, such as technology or market access, opting for equity or a strategic equity partner can create greater long-term value. 3. Ownership dilution versus control trade-off. Equity financing. Issuing new shares dilutes existing ownership. The more equity financing is used, the greater the potential impact on control and voting rights. Debt financing. Debt financing does not dilute ownership. However, lenders frequently impose covenants that might restrict certain activities, providing them with some level of indirect influence. 4. Risk tolerance and business model fit. Stable cash flows support debt. Companies with predictable earnings can comfortably manage debt repayments. Those with uncertain cash flows are riskier, making equity financing more suitable. Financial leverage. Taking on debt increases financial risk. Companies already carrying significant debt might be forced to rely on equity or mezzanine financing options. 5. Decision-making framework. Quantitative analysis. Calculate the cost of capital under different financing scenarios. Assess how each option affects financial metrics like earnings per share and total debt levels. Risk assessment. Analyze your company's risk profile and comfort level with potential increased leverage due to additional debt. Strategic fit. Ensure the financing structure aligns with your long-term goals, considering the trade-offs between control, cost, and strategic opportunities offered by different financing partners. Each company's optimal debt-equity mix is unique. Carefully weighing these factors will lead to financing decisions that support both your acquisition ambitions and the long-term health of your business.